Hi all, I'm P. Karthik Muthuraman, regulatory reporting professional. This is my YouTube channel, Banking Regulations Simplified. In this channel, you will understand the world of banking regulations, in-depth concepts, and the latest trends. Please follow this channel if you want to propel your career aspirations in the world of banking regulations or regulatory reporting. Good luck. Hi all, this is the first of a series of videos in this channel. In today's video, we shall see an overview of banking regulations. This will be a slightly long video, but I bet it will be worth your time. Before we get into this video, let's understand what banks are. Banks are primarily the movers and shakers of the economy and are indispensable to the growth and momentum of each household and the economy. Because whenever we look to the next stage of development as an individual or as a company or as a government, we lend money and banks come into the picture of lending. At the same time, banks over the last 30-40 years have highly deviated from their core objective of lending to the real economy. So this is pose risks which are both necessary and unnecessary, but at the same time, the safety of banks should be safeguarded to ensure the stability of the banking ecosystem and the economy. So this is where the banking regulations come into the picture by setting regulatory frameworks to ensure the risk in the banks are addressed and kept at a minimal level to ensure the stability of a bank during tough times and also during a crisis. Okay, now let's get into this video. These are the contents of the video. I hope the screen is clear. If not, I shall add a complete slideshow towards the end of the video. Okay. Purpose of banking regulation. Primarily, banks regulation ensure that the interests of the depositors of the bank are protected. The depositors deposit their hard-earned money in the banks in the form expectation of a rate of interest, rate of return, and banks use this money to lend. So, which in turn is done back to given back to the public in a different form. And if during times of crisis, of tough times, when people suspect the stability of a bank, they will try to pull the deposits out from the bank. This is known as a bank run. So the first and foremost objective of banking regulations is to ensure the trust of the depositors are maintained by ensuring adequate safeguards are built in the banking regulations. The second is stability of individual banks in broader financial system, meaning each bank in the era of globalization is highly interconnected and sophisticated. The hit or a demise of a bank in some part of the globe will have a ramifying effects in other part of the globe to its peers. That's the danger in the era of globalization. So to ensure that each bank must be safeguarded and ensure that it during tough times it does not fail and prevent excessive risk taking. Like I said, banks have started taking a lot of risk over the last 30-40 years for both good and bad reasons, but the risk has got embedded into the banking model and that cannot be eliminated from the banking system. So there are safeguards built to ensure banks do not take highly risk moves or do not indulge in undue risks. Promote transparency and fair conduct. This is to ensure the safety of and the interest of the customers are protected at all times. This will ensure fair and ethical practices in selling, no mis-selling, and transparency in all dealings, including the pricing and addressal of all customer queries through the ombudsman mechanism. The last is aligning banking practices with public policy goals. Over the last 30-40 years, banks have become a viaduct for money laundering. And money laundering is used to support anti-human activities like terrorism, drug trafficking, and human trafficking. So there have been a slew of measures to ensure banks do not fall prey to this money laundering and detect money laundering when it is done through their own systems. So these measures are collectively called as anti-money laundering measures. Then financial inclusion. Banks should not just cater to the privileged alone in the chase in the pursuit of profit, but also should cater to the marginalized part and the underprivileged part of the society. Aside to that, ESG, environmental sustainability governance, and climate risk. These are all real threats, and we could see them in our day-to-day life nowadays. So this needs to be kept to the minimal to ensure humanity survives, thrives, and nature also is safeguarded. So in this aspect of ensuring humanity and nature are safeguarded against climate risk is done through some regulatory implementations in the lending of banks to ensure they do with a sense of responsibility when they lend from a perspective of climate risk. Key pillars of banking regulation. Prudential regulation. Prudential regulation in simple terms is nothing but assess the risk in a bank, quantify it and set aside some capital or hard cash against it to ensure this cash comes good in terms of crisis or tough times. Conduct and consumer protection, like I said, to safeguard and protect the interests of customers at all times, insulate them from mis-selling or immoral practices. Systemic risk and macro-prudential regulation. So like I said, banks are highly interconnected in the era of globalization. A hit to a bank will have a snowballing effect. So this is to ensure a hit to a bank does not snowball into a systemic crisis or a systemic contagion. This is done through some measures known as specific capital buffers for large banks and stress tests, which we shall cover later in the slide. Then integrity and market discipline. Integrity and market discipline. The performance and health of a bank should be public knowledge because they are closely dabbling with the economy. So this is ensured through regular disclosures of the performance metrics and the risks available in a bank, and which will be public knowledge to both depositors, investors, and peers. This will help people to gauge the performance of bank and also do peer benchmarking. The next is in-depth coverage of prudential regulation. Like I said, capital adequacy. This is Basel Accords. Basel Accords have been the mother of all banking regulations for the last 40-50 years. It's quite interesting and quite comprehensive. Out of that, the main takeaway is capital adequacy, meaning the risk assessed in a bank is quantified in the form of money, and a percentage of that is kept aside as hard cash. That's the idea behind capital adequacy. There are multiple ratios and buffers in it, which we shall see later. Liquidity requirements, LCR, liquidity coverage ratio, NSFR, net stable funding ratio. Liquidity coverage ratio, in simple terms, is the amount of money required for a bank to handle both its inflows and outflows. It is kept aside as high quality liquid assets, HQLA, for and declared to the regulator. This ratio should be greater than or equal to 100%. NSFR, net stable funding ratio, is nothing but the inflow and outflow of a bank required over a horizon of 12 months. It's kept aside as liquid assets, which will help banks stem or tide through a prolonged crisis. So these are all regulations or ratios which were implemented after the advent of the 2007-8 crisis. The next is leverage ratio. The Basel Accords were historically quantifying the risk and keeping aside a percentage of it as capital. But banks have been specifically underrating or rigging the risk models and undercoating or understating the risk and the capital. So this blew out of proportion and exposed banks during the 2007-8 crisis. So as a result, what has been done is the amount of risk in a bank is linked to the capital adequacy. For example, let's say the exposure of a bank is $500 billion. The risk is quantified as $100 billion, and regulations stipulate 10% as capital, which will be $10 billion. Now, leverage ratio divides the $10 billion by $500 billion, and we should come at a figure of greater than or equal to 3%. When we divide $10 billion by $500 billion, it comes less than 3%. Hence, that $10 billion needs to be increased to $15 billion to make it above the benchmark of 3%. This is the concept of leverage ratio, which will push banks to increase the amount of capital they maintain. Next is large exposure limits. Large exposure limits are nothing but addressing concentration risk in the banking model, wherein some banks are highly inclined to certain geographies or certain economies or certain set of customers or clients. So this may be good in the short term, but in the long term, when there are economic crisis specific to a geography or a sector or a set of customers, that will also impact a bank. So this large exposure limits is identifying or understanding the concentration risk in a bank and advising the banks of suitable mitigation action. The next is conduct and consumer protection. This ensures and protects the well-being of customers, especially small customers, which are retail and SME customers. Like I said, fair lending, transparency of fees and charges, suitability of product, meaning understanding the risk profile of the client before suggesting something, handling of customer complaints, meaning the redressal mechanism for grievances should be proper and through an ombudsman mechanism, and should always play middle ground, if not protect the customers and insulate the customers against malpractices of the banks. The next is systemic risk and macroprudential regulation. Focus on financial stability as a whole. So, like I said, in the era of globalization, banking crisis is highly contagious and cascading and snowballing. So, to ensure this does not happen, capital buffers are kept. Normally, there are various types of buffers. Out of them, the important is countercyclical buffer and SIFI. Countercyclical buffer, the concept is behind when things are good, when the economy is hot, lending increases. So this time the countercyclical buffer is kept high at 2.5 percentage to reduce the lending or to increase the amount of capital against the lending. Similarly, when the economy is not in good shape, slowing down, let's take the example of the recent COVID-19 crisis, the countercyclical buffer is reduced or probably made zero to ensure the the extra capital can be used to handle defaults, to handle deposit withdrawals, and to do fresh lending to spring back to prosperity. CFI surcharges. This is a select list of high value banks in the globe which are required to keep an additional charge, additional capital buffer, which will be anywhere between 0 to 2.5 percentage depending on the risk profile of the customer. This list is prepared by an institution known as Financial Stability Board, and that Financial Stability Board publishes this list annually. As of 2024, the list was included 29 systematically financial important institutions. This is also known by another term known as GSIB, Globally Systematically Important Bank. Stress testing. Stress testing is a very interesting concept, meaning it gives hypothetical scenarios to banks to help them understand whether they can survive the crisis, and the results of that simulation is submitted back to the regulator. Some of the simulation scenarios are a default of 50% of mortgage portfolio, sudden increase in crude oil prices by 50%, sudden increase in interest rate by 2%, sudden drop in the price of commodities. These are all various macroeconomic factors which will impact the profitability and stability of a bank, and banks are expected to simulate or assess the impact of such scenarios on their banking model and ensure or assess whether they can survive such a crisis. These results are submitted to the regulator. In US, it is done through something known as CCAR, which stands for Comprehensive Capital Assessment Review. And in European Union, there are certain stress tests which are centrally managed by the EBA. Then resolution frameworks. If the result of a stress testing framework of a stress testing result is not favorable for a bank, then regulators can hold back the capital plans of the bank, stating that they do not have enough capital to survive a crisis. So they should first build on the safety capital or regulatory capital, then start proceeding with their other capital activities like dividend distribution, acquisition, or increase in the remuneration of board of directors and CEOs. The next is integrity and market discipline. So this is primarily to ensure financial system integrity from external risks like anti-money laundering, counter-terrorist financing, KYC rules, disclosure and reporting requirements. Anti-money laundering we already saw. It's to ensure banks do not fall prey to the money laundering, which is used for anti-human activities. Counter-terrorist financing, so along similar to anti-money laundering, but more specific focus on terrorist financing. KYC, this is a complete profiling and understanding of the client, both from a personal and a financial background, before starting a banking relationship and also advising suitable products. This is mandatory across all geographies. Disclosure and reporting requirements, like I said, the performance metrics, the risk and the health of a bank should be disclosed and should be made public knowledge. So this is ensured through something known as Pillar 3 under Basel framework. The next is global standard setting bodies. I'll touch upon some of the important global standard setting bodies. First is BCBS, Basel Committee on Banking Supervision, which is a think tank or brain behind most of the banking regulations in the world, which has been very active over the last 40-50 years. Whatever advancement or improvements or progress we've seen in the field of banking regulations would have been nothing without BCBS. Financial Stability Board, if BCBS is the brain, FSB is the arm. This ensures regulations are implemented by close coordination with G7, G10 countries, head of states, central banks, and regulators, and ensures whatever regulations proposed by BCBS are implemented. This played a very active role after the implementation of regulations, especially after the 2007-8 crisis. International Monetary Fund, this is a friend during crisis. It helps countries during crisis, lends them money to help them build back the economy, and also helps them frame policies and regulations. Bank for International Settlements, this is the umbrella body under which we have various organizations like notably BCBS and FSB. ISCO, International Organization for Securities Commission, is an equivalent or parallel body for setting regulations for securities. IAS, International Association for Insurance Supervisor, is a parallel body for the insurance industry. FATF, Financial Action Task Force, is the equivalent body of BCBS or BIS for setting regulations for AML, and which is anti-money laundering and counter-terrorism financing. Some of the important regulators, United States has a highly segregated regulatory framework. Federal Reserve for banking regulations, OCC, Office of the Comptroller of the Currency, for matters relating to the currency, FDIC, Federal Deposit Insurance Corporation, for deposit insurance, CFP, Consumer Financial, it's an organization which takes care of the grievance and redressal mechanism of customers. Securities and Exchange Commission of America, which takes care of matters pertaining to the stock market. Then European Union is more centralized. There are two organizations, European Central Bank and European Banking Authority. They focus on something known as SSM, which is single supervisory method. Then UK, which has got hived from the European Union, has a similar centralized organization. Prudential Regulatory Authority for banking regulations, Financial Conduct Authority for customer protection. India, we know it's RBI, Reserve Bank of India, for banking regulation, SEBI, Securities Exchange Bureau of India, for security market. Other important economies, MAS for Singapore, Monetary Authority of Singapore, which is the Central Bank of Singapore. In Australia, it's Australian Prudential Regulatory Authority, which is the Central Bank of Australia, and for Germany, it's BaFin. So some of the important regulatory frameworks we've seen is Basel Accords 1, 2, 3, 4, which primarily focuses on capital adequacy. We'll see them in detail in the further videos. Next is stress testing, CCAR for US, Dodd-Frank stress testing again for US. This is for large banks, this is for medium-sized banks. And European Union and EBA, there is also stress testing, which is more centralized. And resolution and recovery, like I said, if the results of a stress testing is not favorable, banks then should hold back from executing their capital plans, then work on increasing their capital and passing the stress test before proceeding with their capital plans. So there is something known as TLAC, not standing for total loss absorbing capacity, which is also equivalent to the capital adequacy, but slightly different, which we shall see later in one of the videos. Then liquidity and leverage ratio, we looked at it. LCR, liquidity coverage ratio, liquidity in high quality liquid assets for 30-day period. Then NSFR, net stable funding ratio, liquidity requirements for a prolonged period of 12 months. Conduct and consumer rules, MiFID is for the derivatives industry, Dodd-Frank for medium bank stress testing in the US, and banking codes of conduct, which will apply across all the globally, and which will be implemented through the nexus between BCBS and the central banks. AML, CTF, we saw. Financial Action Task Force sets the standards, and KYC, know your customers, and anti-money laundering laws. And shadow banking, fintech. Shadow banking, many people understand it's illegal. It's not illegal, but it's parallel, but can create a lot of disruptions and probably break the existing banking system, because that's a parallel system which has enough clout and muscle money power similar to banks. Fintech, we all know There are a lot of fintech companies which are payment aggregators, take deposits, handle your investments, do payments across the borders. The problem is, in the current regulation framework, there are no regulations addressing or defining the rules and guidelines for them. In other words, these do not fall under the ambit of the current regulatory guidelines. This is a looming risk because in the next few years, shadow banking and fintech will grow by leaps and bounds, and any lack of regulation or poor coverage on regulations for them will be probably the reason for the next crisis. Cross-border supervision. So the regulations are highly customized and tailored as per the requirements of the local economies by the regulators. Though the Basel committees give the high-level guidelines for the regulations, they are still tailored and customized for the local economies or local jurisdictions. This poses a operational nightmare and difficulties for complex banks when they have to ensure smooth operations and synergies across the various subsidiaries, and also poses difficulty when they deal with the respective regulators. Regulatory arbitrage, this is the flip side when regulations are customized or tailored for each jurisdiction based on the decision of the local regulator. So global banks have a chance of using them for in the pursuit of profit. So this is a challenges: balancing growth versus safety. Higher regulation will reduce lending because the money you may use for lending, you would have to set it aside as capital requirements, which is a pinch in the pocket. The new risks: cyber security, climate change, crypto assets. Cyber security, we all know it's a highly interconnected world through the internet, and there are many misdeeds performed by hackers, and sometimes countries also use hackers to collapse the economy of an enemy nation or hack into a banking system for stealing money. So now the current regulation does not address this, does not lay the roadmap. Probably these are all in the discussion stage. And climate change, climate risk. So this is advocating banks lend responsibly to handle climate risks. And crypto assets, cryptocurrencies, crypto exchanges, we know are growing by leaps and bounds and have grown exponentially, but there are very little regulations which will protect the safety and the welfare of investors in case of a crisis or a fall in the value of crypto assets or cryptocurrencies. So these are the emerging trends in banking regulation. Tech forward, we need to embrace crypto. That's something we have to live with, but there are no regulations. We need to bring them under the ambit of regulations. Then artificial intelligence, that's also something we need to address, because banking model will expose artificial intelligence that will try to pursue for profit and probably abandon safety. So regulations should cover them as well. Then open banking standards, meaning the current regulation should not cater only to the conventional banks but more to digital banks, crypto asset providers, and to fintech companies. Tailored deregulation. So the complaints, the effort required and the money required for compliance is very high, and small banks find it difficult. For example, Basel 3 was about 2000 pages. So then you need to read that, understand that, interpret that, and implement that, which is an operational nightmare and something which you would have not seen or on an unprecedented level. So this will put a lot of stress on small banks, and however, that is required for them to comply to regulations to ensure they continue in the business. But this is also a pain point, especially from the perspective of small banks. This should be addressed, and this is getting addressed by bucketing the banks based on their asset size. Then central oversight versus states. US is a highly segregated economy wherein each state has its own jurisdiction and a regulator. So these regulators for each state create something which is more favorable for them, which will attract investors and make the banking business flourish in the respective states. But in hindsight, this will disrupt the deployment of uniform regulations in a large economy like US, and will always give scope for rigging the system by adopting or starting or executing banking business in geographies or states where it is favorable for them. Outcome-based frameworks, this is especially the focus in India, where the capital ratio is kept at 9% and a counter-cyclical buffer at 2.5%, 11.5%. Aside to that, there are no major complaints as required in India, because there are other frameworks implemented by RBI like CRR, SLR, and repo and reverse repo rate, which holds the bank in good state in the Indian economy. So that will ensure banks have enough capital to save them, to keep themselves safe, and also have enough capital to lend. So this is kind of a striking a balance, and India is leading the picture here. Then global regulatory cohesion. So like I said earlier, each regulator implements regulations or tailors regulations based on their own dynamics, which is not advisable. Rather, it should be something uniform across globes. So this is also being addressed through the discussions between the Basel Committee and the central regulator. And independence and restraint. So we all know regulations always push banks to keep more capital in the pursuit of safety, but banks would always want more capital in the pursuit of pursuit of profitability. So this is a more of a cat and mouse game. So always banks try to impede the implementation of regulations or delay the implementation of regulations, which is not good. So the regulators should take a strong stand against banking lobbies, and probably strike a middle ground where profitability and safety are balanced. So we have come to the end of the slide. This is a sneak peek about me, about my credentials and experience. So I hope you like this video. For more such videos, like, share, and subscribe. Thank you.